assalamualaikum and hi everyone. So my name is Afi Ashram Sazali and today I'm gonna explain the answers for the question of 1A and also 1B. Okay, so as for the question 1A, in terms of the perspective of taxation, we would advise Newco to set up a subsidiary in Malaysia and instead of a branch. This is because, as we all know, a branch is dependent to its parent corporation, which means it will be reporting and also performing the same business under the same name of their parent's company. Subsidiary, on the other hand, is independent from their parent's company and could engage in their own name in running business activities in Malaysia. Plus, a branch office will also not be considered as a tax resident in Malaysia because as compared to subsidiary, which will be considered as a tax resident and will be benefited from various benefits and tax deductions. Uh, Also, Nuco plan to have only 2.4 million ringgit as a paid up capital, and which in Malaysia, if a company has a paid up capital that is less than 2.5 million, it will be considered as an SME company and will be taxed based on scale rate. Meanwhile, for branch, it is not a tax residence, hence will be taxed based on flat rate, which is 24%. Okay, so as for the question 1B, in terms of commencement date, we have to refer to the main objectives of tax planning. And as we all know, the main objectives are to minimize, to eliminate, and also to delay tax. Hence, answering this question, we would advise Newco to commence their business during the year ended 31st December 2020. And this is because so that they could delay the payment of the tax from paying it early for the year ended 31st December 2019. Plus, Newco could also obtain tax deductions from the revenue expenses once they were commenced. Therefore, they could save their income for the year 2019 by delaying the tax payment to the financial year ended 31st December 2020.
Next is question 1C. In relation to investment tax allowance, provided that this incentive is mutually exclusive with other tax incentive in 1 year of assessment and the total tax relief period of the company shall not exceed 5 years from its production, but eligible to apply for extension or claims any other incentive. A company that intends to undertake reinvestment before expiration of its PS or ITA status may operation for reinvestment allowance provided it surrenders its PS or ITA status. However, Newco have finished claim the ITA after 5 years. The company could claim for the reinvestment allowance. Reinvestment allowance is an incentive granted under Schedule 7A of the Income Tax Act 1967. It is available to a resident company in operation for not less than 36 months that incurs capital expenditure to expand, modernize, automate, or diversify its existing manufacturing business, or approve agriculture project is entitled to reinvest allowance. Effective year of assessment 2011, with the change from period to basis period in paragraph 7A to 7E of Schedule 7A of the ITA, a company is only eligible to claim RA in the basis period for a year of assessment after the year of that basis period for that year of assessment during which the company has been granted or enjoys the other incentive. Newco, as prescribed under Section 4F, may make an application in writing to the Minister to apply for reinvestment allowance under Schedule 7A to the Principal Act for approval. After 5 years of operation, Newco can claim reinvestment allowance and incur more capital expenditure, which is acquisition for new machineries and new factory for the next 15 consecutive years. Thus, Nuco have finished claim the ITA, which is effectively for 5 years, and qualified to claim RA, as the company has complete 36 months of operation to qualify for the incentive. Any excess can be carried forward to future years till the end of the tax relief period. The company is suitable to claim this tax incentive, as Nuco is planning to expand the business by purchasing a machinery and factory that can claim reinvestment allowance of an amount equivalent to 60% of the capital expenditure incurred in the basis period for a year of assessment. The reinvestment allowance is to be deducted against the statutory income of a business, but is restricted to 70% of the statutory income. Thus, when tax liability is assessed on the income of business, the reinvestment allowance will reduce the statutory income. Therefore, the subjected tax on chargeable income of the company will be reduced. Next, question 2A. The answer is any plant or machinery used for the purpose of a business and in respect of which qualifying expenditure has been incurred is disposed of, it sold, discarded, or destroyed of it ceased to be used for the purpose of the business. In relation for the asset being disposed within 2 years, IRB will claw back all the capital allowance claimed in previous year and treat it as a balancing charge in the year of dispose. Paragraph 71, Section 3. Based on the pump car situation where the company had bought the oil machine including stamping machine on 1st June 2019 and the current financial is year 2020, means that the asset had been used by pump car in less than 2 years, which is only for 10 months. That is 1st June 2019 and 31st March 2020. Therefore, it will result in balancing charge for the year of the assessment. Either the company dispose the machine in this financial year or by next financial year. This is because at the end of financial year 2020 or 31st March 2020, the assets are only owned for 10 months, whereas at the end of financial year assessment 2021, that is 31st March 2021, the asset owned still within 2 years, which is 22 months. In relation to this issue, it is assuming that all the machine will be disposed to external parties except for the stamping machine. When the disposal is happened with external party, the disposal value is used in the computation of the balancing adjustment. Thus, it will arise a balancing charge or balancing allowance on the disposal. The disposal value will be taken on whichever is the greater, either the market value at the date of disposal or the net profit of sale, transfer, or assignment. Where the disposal value exceeds the residual expenditure, the excess in balancing charge and is to be added on the adjusted income of the business. Whereas, in the event of disposal value is lower than the residual expenditure, the difference is a balancing allowance, and this balancing allowance will be deducted against adjusted income of the business. In short, Plum Car Sdn Bhd is advisable to hold the old machine for another 2 months to ensure the asset is being used for at least 2 years in order to avoid the drawback of all the capital allowance claimed previously, which will result into balancing charge. Therefore, the company should dispose the old machine after 31st May 2020 in order to become disposal value which is lower than residual expenditure. Hence, the balancing allowance will arise and the company will be enjoy the lower tax liability, since balancing allowance help to reduce the statutory income of the business.
Answer question 2B. To self-test on disposal of the stamping machine, Pump Car Sdn Bhd must dispose the machine after 2 years of acquisition in order to avoid clawback from previously claimed capital allowance. The previously claimed capital allowance will be clawed back and charged as balancing charge when the machine is being disposed within the 2 years of acquisition. Hence, in order to avoid it is advised for Pump Car Sdn Bhd to dispose the stamping machine after 1st June 2021.
My name is Ahmad Abdul Najmi Berusnan, and I will continue with the next question, which is question 2C. State whether Dalmore Group of Companies can make use of group relief to reduce tax liabilities in years of assessment 2020 and 2021. For the solution is, in order to be eligible as claimant and surrendering company, it must meet certain conditions, which is both claimant and surrendering company must be resident in Malaysia. Each must has a paid-up capital higher than 2.5 million at the beginning of the basis period, have same accounting period, both are related parties throughout the year and 12 months prior to the year's assessment, both are not currently enjoying certain incentives. The claimant must have aggregate income in the years of assessment, and both companies must be subjected to tax in full, which is 24%. Palm Castle Berhad, who is the surrendering company, has less than 2.5 million share capital at the beginning of basis period. Since Palm Castle Berhad only has 2.3 million share capital at the beginning of basis period, hence it will not be eligible to be a surrendering company. Dalmore Group of Companies cannot make use of group relief to reduce tax liabilities in years of assessment 2020 and 2021 due to Palm Castle Berhad are not eligible to be a surrendering company.
Answer the question 2D. Rubah Senyang Berhad should acquire machinery through leasing method. Although Rubah Senyang Berhad cannot claim capital allowance on leased asset because Rubah Senyang Berhad is not the owner of the asset, but Rubah Senyang Berhad is entitled to claim the full leasing charges as a revenue expenses because it was incurred wholly and exclusively in the production of income of the company. Besides that, if the business has a current year business loss, the leasing charges will increase the adjusted loss. The current year business loss will be allowed to shelter other income in the current year at the aggregate income level. On top of that, if the current year business loss cannot be utilized in the particular year at aggregate income level, the unabsorbed losses can only be carried forward for a continuous 7YA to set off against any business income in future year. However, Rubah Senyang Berhad is a profitable company. Therefore, there is no issue regarding current year business loss. The full lease payment will be deductible as business expenses, which considered as revenue expenses.
Next, I will continue with the last question, which is question 2E. Advise Damsi on which company should be taken over, TSG Senyang Berhad or KY Senyang Berhad, and the method of acquisition. State your reasons. For the solution, it is advised for Damsi to take over TSG Senyang Berhad through acquiring of shares. This is because through acquiring shares, Damsi will be able to use and benefit from unused tax attributes and tax incentive of TSG Senyang Berhad. Generally, companies are allowed to carry forward their accumulated tax losses for 7 years and unutilized capital allowances to be set off against their future business income, compared to KY Senyang Berhad, which is a dormant company. Hence, Damsi could not be able to use the unused tax losses or capital allowances available in the KY Senyang Berhad, where there is a substantial change in the shareholders. Besides that, if Damsi acquire through business assets, they are not eligible to receive unabsorbed tax losses and tax incentives as it remains with the KY Senyang Berhad and may not be transferred to Damsi Senyang Berhad. In addition, through acquisition through business asset, there is possibility of clawback from capital allowance when the asset is disposed within 2 years. Hence, it is advised for Damsi to take over TSG Senyang Berhad through acquiring of shares.